Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Seb Wallace of Triple Point to talk about the Triple Point Venture Fund. Hello, Seb.
Alex.
Firstly, tell me about Triple Point and also give me some background about yourself.
Yeah, so Triple Point's been around since 2004. We're an alternative investment fund manager. We actually began with the VCT. We've since expanded out from there. We now manage £3 billion of capital from retail, institutional and government sources. We have 5 strategies: private credit, social housing, energy infrastructure and digital infrastructure. And finally, what we're here to talk about today, venture. I joined in 2017 and was part of the team that founded the venture investing at Triple Point.
So tell me about the Triple Point VCT and what it aims to do for investors.
Yeah, the VCT's been around since 2011, although the venture share class that we're here to talk about today has been around since 2018. It's the 5th raise for the share class. It now has £40 million under management, and we have 37 companies, up from 25 the last time we spoke, across 11 sectors. Broadly speaking, the strategy is to grow the NAV, total return, alongside regular dividends for our investors.
So what type of companies are you looking to invest in?
Yeah, the way to deliver returns in venture capital investing is to focus on exits. And so our strategy is built around maximising the possibility of exits. So that means we invest in early stage B2B venture capital. We invest in B2B because B2B companies exit 2 times more than consumer businesses do. And we focus on the seed stage because that's where there's the real opportunity for growth. In the UK, 60% of successful exits happen for under £50 million in total value. So if you're investing at the seed stage, you can still deliver real capital growth with that in mind.
And there are any types of companies that you avoid?
Yeah, I mean, really what we're focused on is companies that have found some degree of product market fit in their early stages. They're not just an idea, but they've got initial customers and initial traction. What we don't do is back businesses that are what we call build it and they will come. They're businesses that have a product that's unverified or untested in the market and have a hypothesis. We obviously expect companies to still grow their products and innovate and find new markets after our investment, but we're not looking at just an idea in a pitch deck.
And obviously one of the most important things is the management team in a company. What do you look for? What characteristics?
Yeah, the overarching thing with the management team is domain expertise, and that can come in 2 forms typically. The first form is that they have themselves experienced the pain they're solving, and they've been effectively the buyer that they're now trying to sell to. In those cases, you can resonate well and you can probably have a quicker sell-through rate. If you're not somebody in that situation, then you've worked in an adjacent sector or have acquired a knowledge of the understanding of the issue that enables you to build a product with your end customers' needs in mind. They're 2 of the core things that we focus on.
So can you give me some examples of recent companies that you've invested in?
Yeah, one example is Trumpet. Now, Trumpet has built online microsites, or what they call pods, to help B2B salespeople. When B2B salespeople are making sales, only 6% of their attachments are open, and they spend over 60% of their time doing administration, not actually selling. So Trumpet's focus is on effectively removing a significant portion of that sales collateral administration, which helps them sell quicker and use data to inform their sales rather than intuition. They've been in the market now for 2 months and they've got over 800 customers, so really promising growth so far. Another business we've invested in is Scan.com. They're a medical imaging platform. They effectively want to be the infrastructure layer for all private market medical imaging. And through them, you can typically get a scan or an image that you need in a third of the time that it takes in the NHS. They plug in not just to private self-pay patients, but to insurers across the UK, Europe and America. And they, for example, have a partnership with Aviva. And they've done over 10,000 scans, and that whole market is projected to grow from 37 billion to 58 billion over the next 6 years. So really promising opportunity.
And what about some of the more established companies in the portfolio? How are they doing?
Yeah, one of those businesses is Ably. They're effectively an API middleware provider. They power a lot of the data, real-time data that you see being used in technology today. They did a Series B with Insight Partners in 2021. Their revenue's grown over 4x since that round. It's looking really strong. Another business is Quick Genius. They're a digital therapeutics company helping people get over their addictions. They did a Series B last year as well with Kinnevik and Atomico, and that business is really focused on their revenue growth as well, and it's looking very strong. A more recent business that's done an interesting round is Veremark. They've just completed their Series A. We backed them at pre-seed. They've just completed their Series A with stage 2 in the US, and that is a 2.5x markup on our last round. So that's looking exceptionally promising.
Besides funding, what do you offer the companies that you invest in?
Yeah, so over the last 20 years, Triple Point's had an opportunity to build a platform unlike many other managers. We obviously have our advisory committee, that's Charles Dellingpole and Christian Fays, both of which are founders of businesses now worth 9-figure sums in the UK. But alongside that, we have a big platform that we use to focus our help to our portfolio. Whether that's, for example, they need somebody to help them do their ISO certification or a penetration test, find an external recruiter or developer, we have effectively contacts in all those spaces. And we also have discounts and offers with over 50 software companies that can help our portfolios grow. Our portfolios predominantly technology and therefore use those types of businesses. And we're really focusing on that value add to sort of accelerate their growth alongside the capital that they need.
And how's the economic environment affecting your companies?
Undoubtedly at the moment, there is a flight to quality. There's lots of capital in the market still, so good founders are still getting backed. At a macro level right now, as we sit here today, energy prices are something that people are thinking about. It doesn't affect our portfolio so much because it's technology based, but we are looking at the secondary effects. So what could that do to consumption at a wider level? But at a higher level, we're investing at seed stage in businesses with a 10-year time horizon. So we're always looking at the economic circumstances through that long-term lens. And if we look back, 2009, 10, 11, those were very different years to 2019, 2021. So certainly there are issues in the market right now, but actually when you stretch out that time horizon, you start to need to see things at a more macro level. And when you do that, a lot of the companies that we're investing in, they have their challenges, their problems, their efficiency hunting. In fact, that increases in times of downturn or uncertainty. And so our focus, that challenge-led, focusing on businesses that have something that's proven in their product, will hopefully stand the test of time, and we expect it to. And so far, the portfolio has been resilient.
Has the portfolio been revalued to reflect the changes in the market?
Yeah, so in the wider market, obviously we've seen this year some significant adjustments. That doesn't have the same pull through to very early stage venture capital. There is of course an impact, but the main pull through is to Series B and above. Now, we do have some Series B businesses, the ones we just discussed, and others. And those businesses we look at prudently. And in fact, across our portfolio, we've made provisions in our February accounts this year on the back of a very large and aggressive year in 2021, where we felt that valuations were perhaps higher than they could sustain in the midterm. We continue that approach, that what we call a prudent approach to valuation now, and we're always looking at our portfolio. What we want to do is ensure that the companies that we have are appropriately valued for existing investors and for new investors coming in.
What are the biggest challenges you face at the moment?
Yeah, so as we said, the market has moved a little bit and it's become more purposeful. We're continuing to see a large number of opportunities, and the best founders are still getting funded because there is good amount of capital in the market. But it's about making sure that you are highly selective, that you're choosing the right founders, because the room for error has just reduced. But there are still great opportunities out there. We're seeing so many of them, and we're very ambitious and hopeful for the next few years. If you look at economic forecasts, inflation is projected to come down. And if we're able to find a soft landing or even a slightly minor recession, we could see a very strong pull through at the other end. So we're optimistic over the coming years. And we've worked on our outbound origination strategy to complement that. Not just working on inbound and with corporates like we have over the last few years, but making sure we're in a position to really capitalize on what we think could be a great time to invest right now in early stage companies.
And what about exits? Have you had any exits recently?
Yeah, so we've had 2 exits since we started. Naturally, we started in 2018, so we weren't expecting the exits as swiftly as we had them. But one exit was earlier this year. It was Credit Kudos, sold to Apple for $150 million. That was a really good exit and a validation of the strategy, we feel. The second exit was in 2020, and that was when we sold Adepto, one of our portfolio companies, to Degreed, the EdTech unicorn. We still hold Degreed shares there. We elected to take Degreed shares, and those continue to perform well, have increased over 100% since we acquired them.
And what about the performance of the VCT? How's that been?
Yeah, we're really pleased with the performance of the VCT to date. Over the last 2 years, we've seen the NAV go from 93p to 109p, and on top of that, we've had 9p of dividends. So we're really feeling in a good position. On a total return basis since launch, we're up 19%. It was 14% last year, which we think is attractive, and we have a good base of distributable reserves from which we can make future dividend commitments.
If someone's going to invest in a VCT this year, why should they consider Triple Point?
Triple Point is a smaller, nimbler VCT than a lot of VCTs available in the market. We go slightly earlier stage with that B2B focus. If you're looking at some of the larger VCTs, it's a great complement. It allows you a little bit of exposure to a different part of the asset class at the same time as trying to deliver you dividends and total return through NAV growth.
Seb Wallace of Triple Point, thank you very much.
Thanks.